Welcome to the STARS program, seniors taking active roles in society. And now, here's your host, Anita Finley.
We're here with RobColson again. RobColson is our specialist in insurance, all sorts of insurance. But one thing he talks about is there are a lot of myths out there, and that's what keeps people from buying more insurance, selling their insurance, keeping up with their insurance. And in your ad, maybe you'll answer these questions for everyone. You say, is life settlement right for you? That's the first question. Why don't you answer that for us?
Thank you for having me again, Anita. That's a major question because for every person, it's a different answer. That's why we never give generic answers to anything, and we always ask the probing questions. And life insurance is a wonderful vehicle for many people, and for many people, it's an outdated situation. Why would that be? Your needs change as you get older. People usually buy life insurance to cover their assets, their tax liabilities, and more importantly, their dependents, children, and spouses. So as we get older, kids become grown up, move out of the home, no longer have the liability of their education going forward. High schools, private schools, college educations, all very expensive today, as you well know. So many people today are both working, mother and dad both working, and oftentimes that insurance is purchased just to ensure that if one or both of them, something should happen to them, that life insurance would be in place. So the current standard of living that family has today could exist after one of those people might pass away. As those kids become older, they graduate, they get out of college, they get married, they have their own kids. Those needs that maybe that policy 5, 10, 20 years ago that was purchased, those needs have changed. And that is the reason why that first question is always there. Is a life settlement right for you? Because we're not here to ask or tell anybody to get rid of an asset they need to pay estate taxes, etc. But another thing I want to mention is that the estate tax threshold has changed dramatically over the last 10, 20 years. The exemption this year is now $5.4 million.
Very few of us have that much.
That's correct. But many, many, many people now have these policies. When the exemption was down at a $2 and $3 million level, a lot of people have assets in excess of that. So they were buying $1, $2, $5 million policies to offset the potential 55% estate taxes. That estate would be taxed if they don't have it sheltered in a trust and or a life insurance policy to pay those taxes. So what's happened is, as you know, the threshold has gone higher for the exemption. So now you can exempt $5.4 million of your assets with no tax liability to your current estate. So those people who don't have $6, $8, $10 million, if the purpose of buying that was to ensure the estate tax issue, that no longer exists. So those are the type of questions that we ask the clients that we deal with because every scenario becomes a different one. But there are very many different scenarios where 40, 50% of the people today no longer want, need, or can afford those policies. So what that settlement market does is gives people an option to possibly have somebody buy that policy from them, and then they could reinvest that into a different thing that they may need at this time. Long-term care insurance, all those things that we need as we get older. That's the reality of what we all are going to deal with one day.
And recently, I met someone who was a widow, and her husband must have had a very large life insurance policy. So now he died, and she can live the same life that she always did, not worry. She's living a very happy life.
That's the objective of the
life
game.
Insurance.
It really is. And when we sit down with people, even if they're young couples, that's what we do. We project out how long those kids will be in the household, how long their mortgage liabilities are extending. And, of course, we have to also analyze what they're young. They're going to continue investing and growing their money. So, obviously, their estate will be bigger when they're in their 40s and 50s than when they're in their 20s and 30s. But the purpose of doing that is twofold, actually. One is for the younger people, there's many different ways life insurance can be used for their retirement planning, tax-free retirement planning. So a lot of the different policies that we can write aren't just straight term, universal life. They're hybrid products whereby the working person can put X amount of dollars into that, just like they do their mutual funds, a savings account, any type of investment they're doing for their retirement today, except the life insurance vehicle can return that to that person when they're 59, 60 years old as a tax-free benefit to them. So we also do that in the structure of tax-free retirement planning, which does two things. One, it provides life insurance for the family, for the kids, for the mortgage, all the outstanding assets and liabilities a family may have. But as those kids get older, now those needs switch from protecting those kids. Probably 25 years down the road, you don't owe very much in your home anymore, hopefully. And now that asset can be used for your retirement. So it enables the customer, the client, to be able to protect the family, protect their home, protect their family from not having the standard of living that they had if something did happen to them. But more importantly, when all those needs are gone, the retirement need is always there. Not many people today, as you know, have these pensions, 401k programs. You can't not open the paper today without seeing some of the pension programs in the country today wanting to cut back on all the employees' pension benefits. So this is something that can be controlled outside of a 401k, outside of a current employee-based retirement program. And it actually does several things for that person. It insures a family, protects them, covers them on estate taxes, and gives them tax-free retirement for themselves.
There doesn't seem to be anything wrong with that. I mean, what's the...
There is absolutely nothing wrong with that. And that's basically a very safe way to invest and cover all your bases, whereby you're providing life insurance for the family, you're providing estate tax coverage if you needed it. More importantly, you're providing yourself with retirement income.
Exactly. Now, the most important thing is, though, to deal with a very good life insurance company. We've never really talked about that. And, of course, you know which ones are really strong and solid, don't you?
Yes, we do. And we, as a broker, we always we resource many companies. So if we're going in to look at a case, we might look at 20 different insurers. All those insurers are A-rated carriers or better, and they're all the common names you're familiar with, the MetLifes, the Prudentials, John Hancock's, New York Life companies. But we have access to all those. It lets us enable us to shop those companies against each other, so to speak, and enable the client, the customer, to get the lowest rate available in the market. Now, the quality of life insurance companies is obviously very important to people, and for obviously a good reason. But one thing you might note is there's never been a death benefit on a life insurance company that's never been paid in this country.
Oh, I don't know that. I'm glad you said that.
Yep, there's never been a death benefit that has not been paid by any insurer in the U.S.
Don't you find that to be just a miracle?
Well, I do, but there's also state and federal backups on a lot of these insurance companies, what we call parachutes or safety valves that they have. And it's kind of like the banks, but they don't leverage the money as much as banks. So insurance companies, what they do is they invest it in very safe, low-yielding assets, whereby a bank might lend it out to 1,000 different homeowners. So that's where the difference is between a bank or basically an insurance company. Insurance companies across the board are just a lot more conservative with their money.
So let's say one of your clients has had life insurance because of you, and they die. Are you the first one that knows about it? How do people know, the families know about the life insurance, and how quickly do they get paid, and how does that all work?
Well, when on the application, they're always going to ask for the owner information, all the beneficiary information. So whether it's your wife, your kids, your best friend, they're going to have all that information on the application, addresses, phone numbers, etc. So obviously the first thing that would happen is somebody's going to go start searching for those life insurance policies.
No, wait a minute. How do they know until someone dies?
The person or
no,
the insurance?
The life insurance.
They don't. It's up to the people to notify the insurance company. And there are literally thousands of untaken death benefits from every insurance company on the street today just because of that reason.
So when they filled out the form, no, it doesn't come from that. So the life insurance company sits there and they wait for someone to contact them. Now, what if it's your person and you know someone dies? Would you be there talking to the family? Is that
Yes,
one of your responsibilities?
Yeah, absolutely. If it's a policy in case that we've written, obviously, they're going to contact us. We'll contact the insurance company. We'll have, obviously, the client customer produce the death certificates that are required for the insurance company, obviously, proof of death. And that process can take anywhere from 7 to 14 days.
And
Not
that's
very
all.
long.
Then
Yes.
a check comes on it.
Yeah, the check will come out.
That's amazing. My guest is Rob Colson. He's one of the most knowledgeable insurance organizations, because it is his organization. It's called US Insurance Auditors. And I love talking to him because I find out I know so much about a lot of subjects, but I know so little about this subject. And so every time he comes, every time I read his articles, I just really love this. So you can call him if you're interested in getting some straight answers. And he's fair, and he's very, very, very congenial. 1-800-218-5033. And you actually will get a free evaluation. So all you have to do is call. He'll come meet with you, and you can ask him all the questions that I'm asking him. All right, so we got finished with that. Now, you say, are you 65 or older with health issues? Why?
Well, because of longevity, because of what's going on today in science and medicine. And as you well know, people are living a lot longer now today than they were 10 years ago, 20 years ago. It's not even close. Also, the tables have switched dramatically on mortality and life expectancy. And what the actuarials that started pricing this program 10, 25 years ago have come back in the last 3 or 4 years and said, you know what, we were completely wrong. We were actually off 30, 40% on our guesstimate on how long a person might live or how long our whole book of business will live. So what they did is they over or underestimated how long somebody might live. What does that mean? When we were proposing 20 years ago on a 75-year-old, on a male, they would project that male would live about 12 years. That same male who reached that same age now is going to live 17, 18, 19 years. So what's happened is those tables have switched. The pricing on the insurance companies' intrinsic tables, what they actually price these policies with, they've changed as well, because now they know that people are going to live a lot longer. So what they had to do is change their pricing. It's caused the market to change, and that's without even getting into the switching in interest rates, which is also reflected in the premium cost of life insurance today. So it's a very confusing thing for a lot of people to sit here and grasp it, and definitely probably over the radio it is. That's why we try and make it as simplistic as possible and ask people, if you have a life insurance policy purchased more than 3, 4, 5 years ago, pick up the phone and give us a call. Because the best case scenario is we can tell you have the best policy ever. We advise you to keep it, and there's nothing you should do. But if that scenario isn't the scenario, we can tell you that there's other options available. There might be something you can do with even the policy you have that insurers are now offering people, reduced death benefits. So if we come into a situation where somebody has, say, a $500,000 policy, they come to us and they say, Robert, we just cannot afford this policy anymore because we were paying $3,500 a year. We just got a bill in. They just raised it to $14,000 a year. So we say, okay, is there still a need for insurance for this family, this estate? And many times they'll say yes. And they say that because they've been paying on this thing for 10, 15 years. And many people feel that they've completely lost this money because they're going to cancel it. They're not paying $14,000. What can I do? So what most people do is they'll surrender that policy for whatever little cash value might be in that policy. So when we ask that question, are you 65 and older with health issues, it's because if you're holding a policy you can no longer need, want, or afford, and you are over 65 with, I'm not talking, heart attack and 3 steps away from dying. I'm talking
bad
issues,
knees, bad hips,
diabetes,
right,
underlying
arthritis.
Things. An incidence of a melanoma incident 4 years ago, high blood pressure with high cholesterol. These are issues we can work around and maybe do something with. But getting back to the options and now insurers are offering people, many times what we can do, if that person doesn't want to surrender, look to sell that policy in the secondary market. many times the insurer will drop the death benefit from $500,000 to $250,000, which would thereby reduce the premium to that person. So obviously the premiums would drop probably to the $6,000-$7,000 level from $14,000, and many times that's a much better economical decision for the client.
Absolutely. See, now, if they decided to call the insurance company themselves and talk about this, they're never going to get the answers that you're telling them. They're just not.
No, they won't. And it's because
it's not in their best interest.
That's right. And what the truth is, the person that answers the phone at most insurance companies today is in a call center somewhere. They have access to a database, a CRM database with names and phone numbers, and they can tell you when your premium's due. They can tell you how much cash is in it. They can tell you your policy date, and they can tell you when it's going to cancel if you don't make the payment. But they can't tell you how to work around the options availability of maybe that you can keep that policy. Maybe they can give you a paid-up policy of $150,000 without having to put more money into this policy. So rather than many people paying 12, 15 years of their $3,000-$4,000 a year, they put $50,000 into a policy and they feel they've lost all this money.
That's very clever of you. See, that's why people need to call you, because that's why I love talking with you. Just what you said, because a lot of people just want a certain amount of money to cover, taking care of that person that may still be alive and to pay for the burial and all. And then they don't have to keep writing checks the same way. So, yeah, you're very good at that. I've never really had anybody that was so creative in insurance. I love this. Well, let's just keep going.
Let me add one more thing on that, too. The best part about that is there's no proof of insurability at that point. So what does that mean? You were 55 years old when you bought this policy. You're now 72 years old. Most of us have some type of ailment, taking medication at that point. You do not have to go back and prove insurability to do those type of switching options.
Why
so the
is
person
that?
could be, if they just allow it because you've already been insured with that company, you're going to just reduce the death benefit, and you're not changing the policy, you're dropping the death benefit is all they're doing. So that's important to add, because a lot of people are probably sitting here listening to this at home going, oh, there's no way I could get anything then now because I just, I have type 1 diabetes now. I didn't have it 15 years ago. Or, I had diagnosed with high blood pressure, my cholesterol, I had a bad EKG 3 years ago. There's no way I can do anything. But I know I cannot afford this insurance policy. So many times they just pick up the phone, say, how much is that premium? Forget it. I can't do it. And that's the end of that.
But that's why when I was having you look at my particular insurance policy, you asked me to get an illustration because that told you a lot about it, didn't it?
The illustration tells you everything about it because it tells you exactly how much you need to put in that policy dollar-wise to carry that policy through what's called maturity.
Well, the fact that I already borrowed on it, could other people be borrowing on their policy? Do they do that?
Well, you can if you have cash value to borrow against. So many times that same scenario, that customers put in $4,000 for 12 years, $48,000. A portion of that would be cost of insurance. A portion of that would be growing into what we call a growth account. So potentially that policy could have $10,000, $15,000 of cash in it. So yes, they could borrow against that. But again, coming back to the initial scenario, if the customer can't afford the policy, our objective is first, number one, is to figure out what exactly can they afford. If they were paying $3,000 or $4,000, can you still pay the $3,000 or $4,000? If they can, great, then we can go back and maybe negotiate with the carrier. If the answer is we can't afford anything, then maybe in life settlement something we look at doing for that person. Because the worst thing you can do is surrender a policy.
I agree.
That's the worst thing you can do.
Don't surrender your policy. That should be the title of your next article. Yeah. Don't surrender your policy.
Because the crazy reality of life insurance is 90% of people have never seen a death benefit.
Yeah, you told me that once before. It's like, it's hard to believe. So they're paying into something all this time, and no one has ever, because they gave it up. Is that why?
That's exactly why. Or people bought term. People bought into the concept years ago. All the local guys 10, 15 years ago were doing all the talk shows. Buy term, invest the rest. Buy term, invest the rest. And that was how people sold this stuff. And the truth of the matter is that can be good for some people and really bad for others. Because at the end of the day, the internal rate of return on a good insurance policy is going to be higher than any investment tax-free you're ever going to buy. And that's if it's written in the right structure with the right company. So a lot of people bought term. And that, as we know, ends at a certain time. Most of them end well before people are in their 80s. And that's why they don't pay. Because here's what happens.
Excuse me. Wait. So they've done a term. Let's say they're 70 years old. It's over. What happens? Nothing. It's just the paper's valueless.
What they if you go to your fine print on the term policy, they have what's called a conversion privilege. Except the conversion privilege numbers are staggering. So let's say, to keep it very simple, somebody buys a $100,000 term policy when they're 50. It's a 15-year term. That person could probably get that policy on $100,000 for $70 a month. So pay that $70 all along. But 15 years, he's going to go from 50 to 65. That policy was bought when his kids were 13 per se. He'll never keep that policy past that date. Because what happens is after that 15th year, that $70 a month premium would probably go to $700, $800 a month.
Really?
Yeah, that's how they escalate it to the point that they force people not to keep them. The only people really taking conversion policies or term are they already know they're sick. Because what happens is you don't have to reprove insurability again. So that 50-year-old on a 15-year, he's going to be 65 when it goes away, right? But if the doctor happens to tell him, Robert, you're diagnosed with, cancer, and I'm coming into the last year, and I know I might not live very much longer, then maybe those are the only people paying those extremely high premiums because, A, they can't buy more insurance because they already have cancer. They're not insurable, but they can keep that one. They're just going to pay through the teeth to keep it.
That's very interesting that you should say that. These are things I really have not heard, but I know I'm always, when people are selling term insurance on television, you can have $500,000 worth for a very small amount of money, and I know it's a trick.
It's not a trick. It's just the actuarials know that people. I can give you real life examples how cheap this stuff is now. A 52-year-old male, $1.5 million worth of coverage, 15-year term, $275 a month. So for $3,100 a year, an insurance company is rolling. Now remember, he's 52. He's going to be 67, still paying $3,100 a month. For $1.5 million of term coverage? What does that tell you? That tells you the insurance company is pretty convinced that person would be very, very healthy at 67, or the kids are going to be gone, and in year 12 or 13, he's going to go, why am I paying this premium?
Exactly.
And that's what happens.
So, okay. So now we got through that. Now, the next question. Are you 70 or older? Why does that make a difference?
Well, because now you're 5 years older than 65. So now the tables actually turn even more on the other side. So that's kind of what you call the caveat. It's 65 with health issues, or 70 and normal healthy.
See. Okay.
So that's really
70 is the another age. So let's say somebody wants to buy life insurance from you, and let's say they are 75. It's going to be pretty expensive.
You'd be surprised. It depends on how healthy they are. And that's the main criteria. You'd be surprised how cheap it is, to be honest with you.
Okay.
And I'm not going to throw quotes out because I don't want it, because it's based on their health, number one.
Right.
When you have younger people and they're buying term, a lot of these companies are doing what's called jet issue. So they'll if it's a small face policy, a 100 or 250, which are small today, and people listening to this probably don't think they are, but they are. Because the market no longer even looks at $50,000 policies. No. And that's what people were buying 20 years ago.
Right.
Because that was a lot of money 20 years ago. And it isn't today. But the market's changed that way. And buyers are a little bit more picky. But that's why you need a broker. You need to resource this stuff. Because trying to figure this out yourself.
There's no way.
No, it's a very difficult scenario because there's so many different options available.
No way. So why don't you give US Insurance Auditors, especially Rob Colson, a call today? The number's 1-800-218-5033. That's 1-800-218-5033. You get a free evaluation, and I'm sure you have a lot more questions than I do. In his ad, there's all these questions, so he said there's another one. So do you have a life insurance policy of $100,000 or more? Now, let's say you get a phone call. Someone has it. What are the questions you're going to ask them? Of course, their age.
Mm-hmm. How long have you owned the policy? How's your current health? Very simple stuff. And that it's really just that. We need to look at basically, because we're going to ask them their age, their health condition, how much insurance do you have, how long have you had, and then there's mathematical formulas we'll look at and see if it's a fit.
Okay, well, that makes sense. Now, have you held the policy for more than 2 years? Is that because of the life settlement? You should have it for more than 2 years?
No,
it doesn't matter.
No, it's because of what's called a contestability clause in every insurance policy.
What does that mean?
There's 24 months on when an insurance company can contest that policy for suicide, all types of different issues. There's what's called a 2-year window there. So policy becomes what's called non-contestable after 2 years, which means the insurance company cannot refute that claim. But in that first 24 months, anything misrepresentation on an application,
I see.
Forgot to tell them you were on Lipitor, they found it on your MIB report. Suicide, those are all contestable issues, because insurance company's not in the business to have somebody go out and buy $1 million policy and commit suicide. So to cover their assets, it's called the contestability period, which is 24 months on all policies.
So you see, just in these few questions, how much we've all learned. Well, Rob, it's always such a pleasure to have you. We got to keep educating everybody. His articles are very good on the new November issue, page 12. You'll see him, and you'll learn some things from this particular article. Buy term and invest the difference, or it is best to buy life insurance when you are young. So that's a couple of things. Thanks, Rob, for being with us, and we'll continue with this next time.
Sounds great. Thank you again.